XYZ Corp. DCF Analysis Report. Introduction. This report is a DCF analysis of XYZ Corp., a publicly traded company with a current market capitalization of $10 billion. The purpose of this report is to estimate the intrinsic value of the company using a discounted cash flow (DCF) model, assuming that the company's funding is entirely based on equity. Step 1. Forecast future cash flows. To forecast future cash flows, we have assumed that the company's cash flows will grow at a rate of 5% per year for the next 5 years. The forecasted cash flows are as follows. Year 0, $1 billion. Year 1, $1.05 billion. Year 2, $1.10 billion. Year 3, $1.16 billion. Year 4, $1.22 billion. Year 5, $1.28 billion. Step 2. Estimate the terminal value. To estimate the terminal value, we have assumed that the cash flows beyond year 5 will grow at a rate of 2% per year, which is lower than the growth rate assumed for the forecasted cash flows. The terminal value is calculated as follows. Terminal value equals year 6 cash flow, discount rate, growth rate. Year 6 cash flow equals $1.28 billion asterisk, 1 plus 2% equals $1.30 billion. Discount rate equals 10%. Growth rate equals 2%. Therefore, terminal value equals $1.30 billion per. Cost of equity 2%. Step 3. Determine the discount rate. To determine the discount rate, we have used the Capital Asset Pricing Model, CAPM, to estimate the company's cost of equity. The CAPM formula is cost of equity equals risk-free rate plus beta, market risk premium, where risk-free rate equals 2%, beta equals 1.2, estimated based on industry comparables. Market risk premium equals 7%, historical average. Therefore, cost of equity equals 2% plus 1.2 asterisk 7% equals 10.4%. Terminal value equals $1.30 billion. Cost of equity 2% equals $1.30 billion per 10.4% 2% equals $15.50 billion. Step 4. Calculate the present value of future cash flows. To calculate the present value of each cash flow, we have used the following formula. Present value equals cash flow, 1 plus discount rate, caret year. Using this formula, we can calculate the present value of each cash flow as follows. Year 1, $1.05 billion, 1 plus 10.4%. Caret 1 equals $951 million. Year 2, $1.10 billion per, 1 plus 10.4%. Squared equals $905 million. Year 3, $1.16 billion, 1 plus 10.4%. Cubed equals $860 million. Year 4, $1.22 billion, 1 plus 10.4%. Caret 4 equals $818 million. Year 5, $1.28 billion per, 1 plus 10.4%. Caret 5 equals $778 million. Terminal value, $15.50 billion per, 1 plus 10.4%. Caret 5 equals $9.45 billion. Step 5. Sum the present value of cash flows and terminal value. We can now sum up the present value of each cash flow and the terminal value to get the total intrinsic value of XYZ Corp. Total intrinsic value equals present value of cash flows plus terminal value. Equals $951 million plus $905 million plus $860 million plus $818 million plus $778 million plus $9.45 billion. Equals $13.76 billion. Step 6. Compare the intrinsic value with the market capitalization. Finally, we need to compare the intrinsic value of XYZ Corp. with its market capitalization to determine whether the stock is undervalued, overvalued, or fairly valued. In this case, the intrinsic value of XYZ Corp. is $13.76 billion, while its market capitalization is $10 billion. This suggests that the stock is undervalued and may be a good investment opportunity. Note that this example is simplified and does not take into account other factors such as changes in working capital or debt payments. Also, it's important to keep in mind that DCF analysis is only one of several methods used to value a company and should be used in conjunction with other valuation techniques. Overall, based on the DCF analysis, XYZ Corp appears to be undervalued relative to its intrinsic value. However, investors should conduct further research and analysis before making any investment decisions. Step 7. Sensitivity analysis. Monte Carlo analysis is a method used for conducting sensitivity analysis. Sensitivity analysis is an important tool in determining the robustness of our valuation. It helps us understand how changes in assumptions can affect the estimated intrinsic value. In our DCF analysis of XYZ Corp, we assumed a 5% growth rate for the next 5 years and a 2% growth rate beyond that. Let's see how our intrinsic value would change if we vary these assumptions. Assumption 1. Growth rate. If we assume a lower growth rate of 4% for the next 5 years, the intrinsic value of XYZ Corp decreases to $13.20 billion. On the other hand, if we assume a higher growth rate of 6%, the intrinsic value increases to $14.34 billion. This tells us that our estimate is sensitive to changes in the growth rate assumption. Assumption 2. Terminal growth rate. If we assume a lower terminal growth rate of 1%, the intrinsic value of XYZ Corp decreases to $12.67 billion. Conversely, if we assume a higher terminal growth rate of 3%, the intrinsic value increases to $15.14 billion. Again, this tells us that our estimate is sensitive to changes in the terminal growth rate assumption. Overall, our DCF analysis suggests that XYZ Corp is undervalued, with an intrinsic value of $13.76 billion compared to its market capitalization of $10 billion. However, we must keep in mind that this is just one method of valuation and there are many other factors that can affect the stock price. As always, investors should conduct their own due diligence and consult with financial professionals before making any investment decisions.